Am I audible? Yeah. All right. Hello, everyone. Welcome back. Welcome to this panel discussion on competitive collaboration between NBFCs and fintech companies. We have our panel on the stage. This session is being moderated by Mr. Bhavesh Gupta, Zonal Manager, Infomerics Valuation and Ratings. And on the panel, we have Mr. Girish Chawla, co-founder Bizloan Private Limited, Mr. Satyam Kumar, CEO and co-founder of LoanTap, Mr. Ritesh Jain, co-founder of FlexiLoans, and Mr. Alesh Avlani, founder of CreditWise Capital. The competitive collaboration of NBFC and Fintech, organized by FIDC, which is the Finance Industrial Development Council, self-regulatory organization, that's SRO, and representative body of non-banking finance companies, NBFCs, and Fintech. This is registered with the Reserve Bank of India. All right, over to you, Mr. Gupta, to take the session forward.
Thank you so much. So good morning to one and all present over here as well as the live audience. So the audience over for this session are around the globe. So to just set the stage right, let me start with India. India, a land of villages where no people thought of buying groceries or vegetables online. They never thought of retails going out of fashion. Similarly, more to India in Bollywood 60s, there was always a part of the story, a favorite character, which was a Lala. This Lala is referred to as traditional looting and manipulating moneylender. So back then, understanding a fintech or taking this lending into the digital way of lending someone to a person not knowing in person or without collaterals or without mortgages would have been like comparing a complete complex or situation people living on moon. So this understanding of or this journey from lala lending to the fintech, this is what we are here for. uh, to the competitive collaboration of NBFCs and Fintechs. I will start with my panel speakers. So first question to Alesh ji. So Alesh comes with a PE background and overseas market understanding as well. So Alesh ji, to you, why this collaboration was exactly required and how you find a need for this to the entire ecosystem, please.
Thank you, Bhavesh, and a big thank you for having us on this panel. Just a little background for those present. We at CreditWise Capital are into two-wheeler financing. It's a unique product of secured, semi-secured, and also a high-yielding product. India is the biggest two-wheeler market in the world. So that's just a little about what we are doing at CreditWise Capital. And you rightly mentioned, right, the journey from Lala to FinTech. India, with with its population, it's just on the cusp of the century that it's going to be having. Lending will be the most pivotal part it will play over the next 20, 25 years. Every single Indian today will be working towards buying things on loan. And that journey is where we are in the midst of, in the crux of. Like a couple of facts, right? India has about 410 approx unserved, new to credit customers who probably never even tried getting a loan. Even if they did, they must have taken it from the people you mentioned, the Lala customers or the Lala lenders. How do you serve them? NBFCs alone, banks alone, fintech alone cannot do it. Each and every single three of them is required today to serve even 50% of those customers, and you'd still be having more. So, ever there is a distinction, why is it that all three of them need to be treated as competing or treated as vendors, right? Is something that needs to change. India has to start thinking more from a global perspective rather than trying to find um, differences between these three. There are pros and cons of each of these three, like a bank, NBFCs, and fintechs that everyone can learn from. Today, fintechs would not be able to be present without the NBFCs. NBFCs would not be able to penetrate as deep without the fintechs. For me today, NBFCs, fintech go hand in hand. And if India needs to unlock the potential of lending, these two need to have not just healthy competition but work collaboratively together for the next 20-25 years.
Oh, that was great. So here we are talking about India reaching its potential to the highest where the credit can go. So understanding this, there should have been more. This way of NBFC and fintech, the collaboration has helped the market in so many ways. So it has simplified the market. To understand more, I'll request Girish ji to put some light on this, on how this can actually happen. Girish comes with a rich experience from banking. He has been with ICICI, Kotak, and a lot of retail banking expertise he comes up with. So Girish ji, please, some insights on this.
Uh, Thank you, Bhavesh. First of all, thanks for having us on the panel. I represent Bizloan, which is a new age retail non-banking finance company. We are basically using technology to a large extent to reach our customers, but the customers happen to be those who remain underserved or untouched by the banks. Coming to our experience of this set of customers and how this collaboration can take further shape or a better shape. I believe that there are three layers we have. We have banks which come with the lowest cost of funds. Then there's a second layer which is larger NBFCs, which have slightly higher rate of interest for the customers because of their further cost of funds being high. And then comes the fintech part. So among these, while the banks have branches, but their policies still remain traditional and not so flexible. So these banks therefore are unable to serve the last mile customer, which is primarily say a very small retailer or somebody with no track record or credit bureau scores. So in this case, the NBFCs come in picture. They have much more flexible policies, much more flexible products, and they are the ones who can actually approach these customers through their branch network. But then they also sometimes move slowly. So they need fintech for a much higher reach. They need fintech to reach those customers who don't even have a credit score. As Alesh said, new to credit. So today fintechs are actually serving almost 40%, or they're getting almost 40% of their new customers, which are new to credit. They don't even have a credit score. So this is the market that fintechs are bringing in, which is being further served by NBFCs, and then the top layer of banks comes in. So what happens here is that NBFC is right there in the middle. NBFCs would tap fintechs for origination, and then they would tap banks for co-lending. So it's a three-way process, which is a win-win for all. I think that this is the future of this collaboration, where the lowest cost of funds gets actually transferred to the customer, and the customer who would never be able to actually approach the bank directly reaches the bank's books. That's exactly the way this collaboration should actually be.
Wow, that has been a great insight. So, a lot many stakeholders over here we see. It's bank, is NBFC, is fintech, is client, and the moment to moment, how the things are flowing, how the movement is flowing. To understand more on this, I request Ritesh to have an insight on. Sorry, firstly Satyam, to how this implication happens, and how do you look at the future of this collaborations going further, please.
Yeah, thank you very much, Bhavesh. So, at LoanTap, we handle all retail loans. Essentially loans between 1 to 10 lakhs. So, we dabble in MSME, extremely retail, and a lot more on a consumer side, which is for personal consumption needs and all. And also we do some new age products like electric vehicle lending and also. So this is what we do. Essentially, what we see is that NBFC, as Ms. Chawla was rightly mentioning, they have been willing to take risk in past also. What it essentially creates is it creates an ability for an innovator to create a product or create a journey which has a less friction. So a natural partner for any fintech or anyone who is really looking for it to innovate, either on the segment side or on the product side, it becomes an NBFC, which not which is always also seen and called as a parabanking, shadow banking. So it has not been called for no reasons. The reason has been that they have been willing to experiment with their distribution. They have been willing to experiment with the segment that they want to lend to. They have been willing to also experiment with the product or the categories where they want to do a lending. So the moment you want to do a innovation, whether it's a tech-led innovation or a particular need-based innovation, then an NBFC becomes a natural partner as far as availability of the credit itself is concerned, which is regulated by and large by RBI in terms of who will be able to create a credit or who will be able to do a credit in the society. So from that point of view, there is a huge space, and what we have been seeing is that we have been seeing a great growth coming in, and particularly it is coming because of one reach, newer distribution which is getting created, which is a data-led distribution from the fintech part of it. And the second which is getting created is that there is a lot of operational flexibility is getting created by lowering down the operating cost when you look at the whole set of the data-led journey as well as the tech-led journey. So two of the most critical part which was hampering the growth of NBFC sector was about running with a high operating cost, which was a branch-led model and all. And now you are seeing more and more NBFC catering from a single branch based out of a Pune or based out of Bombay or based out of Bangalore to more than 5,000 or more than 10,000 pin codes across India. So that's a pure reach which has been enabled without having a branch-led network. So an NBFC sitting out of one location is catering from a Kanyakumari to Kashmir, all these locations. So the distribution is what has been brought without putting additional cost to the entire operation. The second which has been bought is the product innovation itself, which is where you are getting more recent data, newer kind of a data, and each of those data are very relevant. So recency of the data, lower cost of operation, and anywhere kind of a distribution on a digital journey, all three of it becomes very important for running an NBFC operation at a low cost. And what is also getting is that post validation of the idea, once you validate the idea, you validate a portfolio, then you start seeing a mid-sized bank or a large-sized bank also come and participate in the risk environment. And that is where a couple of enabling regulations has also come as we in this sector. So what it has done is a fabulous in terms of fraud prevention, distribution, keeping the operating cost low, and institutions' ability to design a product even for a micro segment of the customer. So these are the things which I see a great value add in this relationship when it comes to a partnership between a fintech and an NBFC for that matter.
Wow, that has been a true insight with your expert understanding of the retail market, what you have. So a lot of things where we came across. So Satyam sir talked about the technology. He talked about the new product innovation. He talked about new market and new person adapting to this. So when we come across this newness of new products or new market, there is always a question on how this tech acceptance is there into the market to the people around, and what are the related threats or disadvantage to the customers or either to the from the NBFC fintech understanding as well. So because you come from a technical background, I mean, you'll be the best person to give us the insight, please, sir.
Hi everyone, this is Ritesh. I'm co-founder of FlexiLoans. I'll just FlexiLoans as a company, we are an embedded finance player. We empower fintech companies or large companies to become MSME lender. At the same time, we give MSME lending, MSME loans across India digitally. What my fellow panelists have said, like we are doing exactly the same thing, and I'll elaborate on that particular piece, that how we are doing and how it is being accepted by various large players and banks. Like we are based out of Mumbai, and through Mumbai we are capturing, or we are providing coverage to 2,000 cities and 15,000 pin codes. Now this was not possible for a large NBFC or bank to do loans. Now what is happening in terms of partnerships? Now large, though FlexiLoans is also NBFC because we are on the right side of regulation, but large NBFCs are integrating with us to provide loans, and they can access these 2,000 cities without setting up of branches. So this distribution power. So because we are bringing so many customers, there's lot of acceptance. Acceptance wise, if you see this conference, if you walk around, so much of collaboration is happening between large players and small players. There's no doubt that there's a lot of acceptance between fintech and NBFCs through that particular concept. The second point, I'll take you through 3 points around the acceptance part. The second point is around the product innovation. Like, like Bhavesh, you rightly started with, like there are money lenders, and if you take example of MSME lending, still only 15% of MSMEs get loans from organized players. And money lenders have been, or family offices or family parents have been financing these needs. And we are really disrupting the business of money lenders through this product innovation. Typically, large banks or NBFCs would provide loans above 10 lakh rupees, and they cannot serve economically viable loan for a small ticket size loan. Now, as FlexiLoans, we have launched various products where, for example, BNPL, like traditionally distributor used to provide 10-day credit. Such kind of products were not possible through NBFCs or large banks. We empower these products where a typical retailer, when they're buying 20,000 rupees ticket size of goods, groceries, that particular retailer, instead of paying after 10 or 20 days, they can take 2% discount upfront and get that finance. Imagine person was paying indirect cost of 60% per annum of financing, getting finance through distributors, which we are able to disrupt. And through lowering the ticket size, we are disrupting the entire market. So similarly, and this will happen in lending. This has happened in payments also. If you see what has happened, like UPI, before UPI came in, there were 5 million credit card accepting machines. And with the lowering of cost, when QR code based acceptance came in, like the number has increased to 50 million. Now 5 million to 50 million, imagine the kind of coverage it has provided. Who would have imagined that you can pay a milk payment of 50 rupees via digitally? That is happening. That will happen in lending also. That is happening in lending by reducing the sachet size of loans. So that is the second point on the product innovation, which companies like us are actually disrupting the market around this particular player. The third thing which my fellow panelist has said, and I'll give the exact example around this, is lowering of cost. Because smaller ticket size loan was not possible with the high cost structure that was prevalent due to branch-based banking. Now there's a collaboration not only between fintech and NBFC, there's a collaboration between fintech and other fintech players. Like yes. KYC is the best example. Earlier KYC used to take 500 to 1,000 rupees if you have to do a KYC or OSV of the person. Right now you can do OSV at the cost of 5 rupees or 50 rupees, as the case may be, the kind of model you are adopting. There is either 100th or 1/10th reduction in the cost, and smaller ticket size loans are possible. So because of this huge benefits, there's lot of acceptance. We are seeing lot of acceptance between banks, NBFC. There's no disruption. There's no competition around it. We are empowering each other. But rightly said that there are certain threats also which you wanted to ask that particular question. In the process, if you see that those threats in the process right now, if you take a typical loan journey, there are a lot of fintech players and lot of players now are involved in that particular journey. Earlier, traditionally, the customer will walk into branch of the bank and only one player was involved. But right now, because there are multiple players involved, the personal information of the customer is shared with lot of players, either in the process of KYC, either in the process of document image recognition, or in the process of NASH registration. So there are fintech players involved in the process of loan journey, and personal information of customer is being shared
So
with lot of players.
data security is what you are
Right,
trying to
right.
say,
So
that
data security over
that
there
is a stake.
is a cause of concern.
Yes.
But government is coming on RBI. If you look at the
Yes.
RBI latest paper, they are coming up with right set of regulations wherein consent-based architecture is being proposed. And if the customer is giving consent, and then only the information can be shared. The DigiLockers of the world and other assets will also help in uh, reducing this threat of sharing of personal information or leaking of personal information. Yep.
Thank you so much for that great insight. So we see how the acceptance has been going. We see how the collaboration of NBFC, fintechs, and other players in the ecosystem has been handled out. In this is the most, I believe, important part of the sessions, where we will explore more on how these things are happening. So, Mr. Shaktikant Das, the Governor RBI, one of the speakers in this GFF, so he clearly mentioned where the fintech is the highest growth segment, and they will take all the ways and means to protect and safeguard the stakeholders and the all related stakeholders. So on this, uh, Satyam sir, I'll like your input on, or your opinion, which is the best uh, move what RBI or the regulator has taken for this collaboration. Sir, please.
One of the issues that we face is the lack of regulation, and what has happened in last 6 to 7 months is the growth of fintech during the pandemic, even pre-pandemic, had clearly made it as a mainstream rather than being one of the development in the economy. That essentially ensured that both the government and the regulatory ecosystem came together to form the initial framework for how to regulate the sector. So having a regulation is one of the biggest thing that you want in a country where you are working at the sidelines of the society, where you are touching people's lives, and in a country where still you have so much of a linguistic barriers, you have so much of literacy, or a digital adoption on one end. At the same time, we are talking of data privacies, sensitivities of informations and all. So you have all these barriers coming in. So regulation was the key requirement, because if you are not regulated, then probably anybody and anyone can come and start challenging your authority to operate in that particular domain. So having a digital lending guideline in whatever form it is, so we all have a view how enabling, or how better it could have been. But from that point of view, having the base guideline itself is the biggest success story of fintech coming off as an industry in itself, and not being only seen as one of the arms of the whole lending ecosystem. So once that part has been taken care, the second and the biggest enabling mechanism came in was about 1.5 year back, when the bank branches were shut, the NBFC physical ecosystem was shut. At the same time, the government decided to enable credit as one of the mechanism to fuel the economy during the pandemic. So unlike many other governments outside India, there was no direct credit to individuals other than a certain farmer segment and other segment. That means what was enabled for the businesses to run and the economies to keep on sustaining was ECLGS and different schemes which came from the government to expand the credit in the market, to provide a credit or a support it by the credit for MSME to run. So both In that period, the banking sector and NBFCs realized that they just can't operate without the support of the fintech in a manner where the people are not able to reach branches, customers are not able to reach branches, branch after branch has been going through a COVID lockdown because of one or another contamination. So the whole process got augmented. So, pandemic brought a big shift in the way the banking system, NBFC system saw the technology participating or co-participating with them. So that was one was the event. The second was two stuff which came as a co-lending enabler, and the second and the first one, as I said, that having a guideline for the industry as a digital lending framework itself was so important for us to know that these are the boundary conditions, these are do's, these are very clear don'ts and all from that point of view. So this is what we have been, we see as 2 to 3. One was enabling event, which fast-tracked the whole stuff, the way demonetization fast-tracked the payment adoption. The same way COVID fast-tracked the digital lending adoptions, both from a customer side as well as collaborator side of the economy. So this is what we see. And a co-lending which frees up the balance sheet. So it allows tech to dip into NBFC balance sheet. It allows an NBFC to dip into bank balance sheets in a shared risk environment from that point of view.
Oh, that's great. So, understanding this, we are talking about regulation. We are talking about sharing, co-sharing things. So, we are a diversified country. We have different type of NBFC. We have different type of fintechs. Some might be into auto loans. Some might be into personal. Some might be into labs, and so on and so forth. So, this regulatory boundaries we are talking about, and the um, moves we are talking about, obviously there might be. So this one is for Girish. So, to your understanding, what regulatory move impacted NBFCs and fintech in an adverse way? Because everyone has some pros and cons. So, what are the moves as per your understanding that might have impacted on the adverse way? Please, sir.
Uh, so, using the word adverse actually might start some controversy. So, I don't think that there's anything adverse in the regulation that has come. Uh, to start with, there's only one part of the entire regulation which is still being discussed. I try to harp upon all the parts of the regulation that has just come in on September the 2nd. So, out of these, it is only the FLDG part which is still being debated within fintech and NBFCs, and even the banks are a bit worried about how would they get covered on risk side. Uh, while the governor himself a couple of days back in this forum stated that the issue is under examination, so I don't think that I need to speak much about this, and only the time will tell how we all as finance players do a round around on this particular issue. Other than this, if you look at the entire regulation, it covers a few points. So let me break it into two parts. So one, it talks about customer data management. We just discussed how important it is to secure the customer data, and we all wanted a regulation around it. Two, localization of cloud data, which again is an important factor. We've seen that how cyber attacks have made our customers so vulnerable, and the data security, if it's kept locally, is much better. And three is KYC. Now these 3 points have already found buyers within the industry, and a recent BCG study also revealed that almost 90% of the respondents, which are from NBFCs and fintech, and even some participants from banks, accepted these regulations and they welcomed them. The next part of the regulations are more operational in nature. So one is setting up a nodal office or appointment of a nodal officer. In my view, it will only reduce the customer grievances, or if not reduce, it will help in resolving customer issues in a much faster and better manner. So that's, again, a good guidance too. Then we have cooling off period. Now, there have been issues when the customers actually feel misguided. Uh, you know, just coming back to the first point that you started, there have been certain players or apps which actually played like invisible uh, lalas, so to say. So the customers did not have a choice. Once the money comes in their bank, they would not have a choice but to understand, but to
Obligize with the whatever the terms and
exactly, yeah,
conditions were there.
there were actually no terms and conditions. It was whims and fancies, so to say,
Yes.
in certain cases. So
Okay.
it is good to give customer an option around
Mhm.
this. It is always better that customer kind of
Right.
has a visibility around what terms has he gotten into it, and if he wants to reverse his decision of taking the loan, he can be allowed. That cooling period can be of 3 days also, which
Right,
is what
right,
the
right,
regulator
right.
has said, which I feel is good enough. Then another part is reporting of loans, all loans. Now we are in micro segment, and we come across a lot of customers where their loans from the so-called credit societies or pathpidis are not even reported, so we don't even get to know how their loans have behaved.
Right.
It is always a good idea to get everything reported. At least the customers would have a bureau score, right? They would they would get into the organized segment. A lot of these micro enterprises which are there in tier
Uh,
4, tier 3.
Giriji, sorry to cut in between. If you can just shorten up because we are running out of time and we have two more important questions,
These were the two
please.
parts only. So
Acha.
this was the last one among these. So these this regulation also, in fact, helps us all in taking a better credit underwriting decision. So in my view, I don't think there's anything adverse. It
Good.
can only be a short blip, but nothing adverse around the regulation.
Obviously, when regulator is coming out with 4, 5, 6 notifications for particular sector every month on month, it has been consistent. Though it be March, April, May, every month at least 5 to 6 circulars, notifications, FAQs you see over there. So obviously there might be some glitches, but the things are been taken care on the long run. Coming to this, on the there has been a mushroom growth on technology. Yesterday, the governor for Mumbai, he was here. So he clearly, Devendra Fadnavis, he clearly mentioned and declared Mumbai as the fintech capital as well as the startup capital. So this one is for Ritesh. Ritesh, we will need to keep it short in 3 minutes. I will not take much time. So your advice to the startups and fintechs, that is one. And no, we will keep it to this. Your advice to fintechs and startups, please.
I'll have three advice to them. Think about customer, think global, and think about security. Think about customer because customers' expectations are evolving. Traditionally, what has been happening is this sector, people were thinking not regarding customer experience as paramount, but customer experience is changing. Earlier, customers are getting deliveries in 2 days. Right now, they're getting deliveries in 10 minutes. So that might be in e-commerce. Now they're questioning why can't they get loans in 10 minutes? So that kind of focus has to be there on the customer side. Secondly, it is very important to think global. Right now, every company is thinking about India only, how fintechs can serve banks or banks can have relationship with fintechs as a vendor kind of relationship. But both fintechs and banks have to think global. Like UPI is going outside India, why can't fintech solutions go outside India? Why can't banking services go outside India? What the way Apple products are being distributed across the world, why can't banking services or fintech services be launched across the globe and India become a leader in fintech services? So think global. And lastly, this will not be possible if there is a self governance governance on the security part. Fintechs have to level up their bar on the security part of it, and then only this will be possible.
Hello. That's a great insight for every upcoming startup and fintechs over in the crowd and to the audience. So this will be no doubt duly noted by our audience. Coming to our last final point of the discussion, which I like Alesh ji to handle this. So ministry is listening, regulators are listening. They have been proactive on how the fintechs need to be handled on the regulation side, on the boundary side. As per you, what will be the suggestion if as a fintech to the regulatory body? And after this, I like if you can sum up a total understanding of the total session, please.
Sure, Bhavesh. You've given me the concluding ones, the most dangerous ones, straight to the regulatory department. But my request straight to like FIDC, the regulators, is just don't let a couple of bad apples define the entire basket. Yeah, we do understand that there have been a couple of fintech players who have misused data, misused KYC data, but that cannot be the norm. You cannot let India reach its $5 trillion economy by like putting brakes. Lending will be the one of the biggest parts, right? As you rightly said, fintech is the fastest growing ecosystem in India. Lending will continue to be a major part. If we want to grow together, FIDC, regulators, all of us need to understand one thing. Maybe we can have stricter norms while onboarding, for example, now, and maybe NBFC licenses, right? Today, you get an NBFC license with a net worth of 2 CR. NOF required is 2 CR. Maybe we can increase that limit. So fintechs probably who are just about starting off, early stage fintechs, not everyone gets a license. Maybe we can only look at those companies that have raised some kind of equity, they have that capital, they have some kind of corporate governance in place, and then they start applying for licenses. Maybe we can have, as most of the co-panelists also said, that focus on security, focused on data. Those things need to be factored in even more. And like complaint redressal issues, right? Yeah, okay. As Satish ji rightly said, right? There have been challenges where customers don't know what they're getting. Maybe have some policies coming into place that you check exactly how communication happens with customers. But straight away putting brakes, the circular coming every 4-5 times a month, it just confuses the entire ecosystem. Doesn't allow us to focus on our core focus, which is servicing the customers and providing them something which they can grow from. For example, like a two-wheeler loan, which we are focused in, or a consumer loan. It's probably the first product individuals take on financing in India. Like it's an average young age, 27, 26-year-old who's taking a loan. If you put a challenge for him to not be able to get a loan, the first loan itself, he's going to struggle for the next 5 years. He's not be able to build credit history when he wants to take larger, bigger loan products. So it's just aspects where maybe we can make it stricter on who we onboard, how we onboard, and have those checks in place. But straight away putting in brakes, banning certain things like prepaid card, credit cards, BNPL cards, it just confuses the entire ecosystem. And I'm sure that in Harmony and Fintech, NBFC and Bank, for me, they all three are not separate entities. For me, they are India's Fintech ecosystem and needs to be evaluated and looked at as a collective rather than an individual entity.
Thank you so much, Aleji. You have been a face to NBFC and Fintech at this summit, and you are your no doubt regulators are going through this. So let's see how this is accepted on point. Quickly, I will like to take some questions from, or one or two, probably a question from the audience. Anyone?
Hi, this is Abhiram from India Partners. Thanks to all the panelists for sharing their insightful comments. Just one question I had. Uh, where do you see as the end game for the fintechs at some point of time for them to become large and uh, impactful in the ecosystem? Do they need to become NBFCs or banks, or can a fintech survive and be a large entity without being an NBFC or a bank? Thank you.
Fintech has no limit to grow. I mean, sky is the limit on point. But I'll open this for panelists. Anyone?
If you see, what you definitely need is an RE ecosystem because of our data sensitivities and all issues that institutions comes across. If you do not have an ambition of making a big on the interest or risk income, then having an AA ecosystem is the best for a fintech. So where you are able to hold the data, you are able to share the data, you are able to analyze the data. So an AA license from an RBI is the best one to operate with. Otherwise, an NBFC or in any other manner, the same can be achieved.
I'll just add to this, like fintech is a very broad spectrum. They could be technology companies, like if you see walk outside, there are companies who are just doing like reading documents efficiently. There are companies who are improving certain processes. Those they are creating IP in itself. So those IP or technology companies can grow without getting into a regulatory umbrella. People who are just who are distributing loans or who are distributing services, they will have to get into regulatory umbrella in form of NBFC or getting into license. That's the aim.
Thank you so much for the inputs. A big round of applause for all the panels. I see a full house session. And thank you so much for the panelists for joining. Thank you so much.
Thank you, Bhavesh. Thank you.
Thank you.
Absolutely. Thank you to everyone.
Last but not the least, FIDC, thank you for giving us an opportunity on this. Thank you.
Thank you so much. May we request everyone to please pose for a